Hello and welcome to the Level 1 Masterclass series in Corporate Issuers. My name is Darren Lee and I will be working with you through all 7 of these modules. Now the Corporate Issuers topic area looks at the basic concepts involved regarding how corporations are organized and governed and how they make operating, investing, and financing decisions. This first reading describes and compares the legal organizational forms of businesses, emphasizing their similarities and differences, plus the important implications for investors. Now, the 4 general business structures that you must understand in detail, of course, are sole proprietorship, limited partnership, general partnership, and corporations. So I'll put a star on that. That's a definite must know. In practice, the most important business structure to analyze, and probably the likelihood of the most test questions, of course, will be the corporation. Now that's given its potential complexity, and it will be critical to distinguish between private and public corporations, for instance. So that's sort of another point that we raise in this second bullet point. Okay, let's continue here. Now, the simplest organizational form is, of course, the sole proprietorship, and we'll start off with a brief discussion of that. Now, here the owner provides the capital needed to start and operate the business, and of course also retains full control over management and participating fully in the firm's financial returns and risks. Okay, so think of this as essentially, a mom and pop setup here, a one-man or woman show here. It does not require any formal legal registration and is simply dissolved when the owner ceases business activity or passes away. Okay, so pretty straightforward, pretty intuitive. I'm sure many of you sort of understand and see this in practice often here. Now, sole proprietorships are the most common business form in practice. And of course, as you can imagine, they are preferred by small business owners. Why? Because they're simple and flexible. Now, of course, you want to keep in mind that their growth, of course, is constrained by the owner's ability to access financing and assume risk. So just by nature, your growth opportunities will be really limited with the sole proprietorship. Okay, so we started off with that. Now let's move on and go to partnerships, or think about, compare and contrast here. Now, of course, this here allows multiple owners to pool their resources and to share business risk and return. So 2 or more. Now, there are 3 types of partnerships in most jurisdictions, and we have listed them on the slide. So, of course, it goes without saying you should have a basic knowledge of all of them. So I'm going to sort of walk through these with you. General partnership is essentially a sole proprietorship, but... right, and the but here is that there's 2 or more individuals, so there's the complementary expertise that is brought into the business by the partners, along with the sharing of business risk, profits, and responsibility in operating the business. So, the thought on this is that, hey, 2 heads are better than 1. We can work together, and this could be more productive and profitable than a sole proprietorship, for instance. Okay, in terms of liability, of course, if one partner is unable to pay their share of the business debts, of course, the risk is that the remaining partner or partners are jointly and fully liable. Okay, so that's a really key point that you want to note here. There is, in theory, unlimited liability for the debts of the other partners. So in other words, you better trust the partner or partners that you're going into business with. Now, with a limited partnership, the limited partners do not usually have management responsibilities. Now, there is also, of course, by the but you can tell by the name here, limited partners, limited liability. So what's advantageous here is that the personal assets are considered separate and therefore protected from the obligations of the business. The general partners, in this case, if we had to distinguish between the general and the limited partners, usually get a higher share of the profits because they assume more risk and personal liability. And then finally, at the bottom of the slide here, I just want to say a little something here about limited liability partnership. This is, of course, to avoid the unlimited liability risk for the general partner. So instead, what we have is all the partners have limited liability and they all share in management duties, although one or more partners may be appointed as managing partners. This form is usually only permitted for professional services firms such as law and accounting. All right, let's move on now to companies and then getting into corporations. So we're going to start here. This is sort of the third form here. We've sort of gone into sole proprietorship, gone into partnership. Now we're in a company. So starting with private to limited companies. Now this here obviously allows for better transferability of ownership interests. Because what we have is we have shares, okay, and so by having shares, transferability is easily facilitated because they can be traded. There's also a distinction between owners, and so I'll sort of illustrate this. Owners or shareholders as one party versus, of course, the management team. Okay, and we'll get into agency and all sorts of things there afterwards. Now, here the shareholders actually elect a board of directors. Okay, and I'll just put that up here, the board of directors. So that's elected here by these owner shareholders, and the board of directors appoints the professional managers to manage the company. Going further, public limited companies are similar to private limited companies, but they face no legal restrictions on the number of owners or ownership transferability. So they are, of course, the dominant organizational form globally based on revenues and asset values. Now, the most interesting aspect to consider is the issue here of taxation, okay? Where profits can be retained and reinvested in the company, thereby avoiding or deferring tax at the shareholder or personal level. So we're going to get into an example where we talk about the two levels of taxation. There's the corporate tax and then there's the personal tax. And we look at some basic methods here that defer the tax, and also we do calculations to illustrate the two levels of taxation that are going on. But more on that coming up shortly here. Now, this slide reiterates comments made earlier about liability for business debts. Okay, so for the general partnership and sole proprietorship, there is, of course, no separation between personal and business assets. Okay, so this, when we talk about being personally liable, that is, of course, full liability. Now, in contrast here, if we're looking at private limited company, there is a clear separation between personal and business assets. So, of course, with the word limited, then it's partial liability. You can only lose up to what you invest. Okay? So let's take a look at a practice question here. Now, this question is another way of covering the same material in the previous slide. Okay, now here we know that there is full liability for the general partnership and the sole proprietorship. Okay, so those then would be considered the most amount of owner liability. So through the process of elimination, I can knock out both A and C. And so we know here that the correct answer must be B, since the private limited company, of course, clearly limits the liability of the owner up to the value of their investment. And that's just reiterated here on this last point. Okay, so that should be really clear to you at this point. And as promised here, I'm going to go into the next example here and illustrate to you the concept of double taxation, or taxation on two levels. Right, and using numbers here, I'm going to show you the corporate and also the personal or the shareholder level. Okay, so let's take a look at this example. 21% tax rate, pre-tax of 100 million, and then so that's the first level of taxation, and then there's a distribution to the shareholders, and then they pay tax on that. So let's take a look and see what's going on here. Okay, now we know that the corporation has to pay tax at 21%. So if you look at that, then you know that we have 79 million of income remaining after the 21% tax is paid at the corporate level. So of that 79 million, only 10 million is subject to additional shareholder tax of 20%, while the other 69 million avoids the additional tax until it is distributed to the shareholders. Okay, so just to illustrate here, again, just remember 79 million left, and we're going to say 10 million taxed now, and 69 million presumably taxed later on. Okay, so if 10 million is taxed now, that makes sense here that we have to pay 2 million in taxes, the 20%. Okay, now I'll sort of go on and say, now assuming here that the entire 79 million is eventually distributed, then the total tax paid, of course, would be 15.8 million. Okay, and just illustrate 79 million times 20%, of course, would be 15.8 million if it was all distributed. So looking at all of this together here, the total tax liability on the 100 million in pre-tax income, what is that going to be? Well, this is going to be the personal tax, the 15.8 million, and then the 21 million is the corporate tax. So the two of them together would be 36.8 million. So if you were trying to figure out the imputed tax rate here, it's 36.8%. That's the imputed or the effective tax rate on the dividends after both levels of tax are considered. So you can't take a simplistic approach and say it's 21% plus 20% because, of course, what's remaining after the 21% paid is subject to 20% tax. So it's not the whole thing. Okay, so the other way, of course, to do this is you could look at it sort of like this, right? And what are you going to have left? So this should come out to 0.732, which is what you have remaining, which is sort of the other side of the 36.8% tax. Okay, so I hope that this drawn out example makes the point nice and clear. All right, so here is a very nice summary of the 4 general business structures, and I would find this to be a very useful study tool. So I'll put a little star on this to know. This will cover all the essential knowledge you need to possess to be successful, I think, in answering virtually any exam question in this area. Now, we've covered through our discussions pretty much all 5 features of the 4 business structures so far. Okay, now let's go on here and examine the 5 features of corporations in a little bit more detail. Okay, I just want to elaborate on what exactly we're talking about. So we'll work through them in turn. So legal identity, right? Corporations, of course, share many of the rights and responsibilities of an individual, and they may engage in similar activities. Now, for example, corporations can enter into contracts, hire employees, invest, and borrow money, for example. Larger corporations may have business operations in many different geographic regions, so there's the added complexity of compliance with multiple regulations. Moving on to the next point here, number 2, in a corporation, shareholders are largely removed from the day-to-day operations of the business. So, as I said earlier, it's the board of directors that's elected by the shareholders who then appoint the executive level management. Now, both the board and management, of course, must act in the best interests of the shareholders. So there's a term that we use, fiduciary in this case, right? By separating ownership and management, the corporation is then able to seek financing from a much greater pool of potential investors who don't need to be involved in management. Now, number 3, which we've talked about quite a bit, liability of shareholders, of course, is limited to what they have invested in the company, and they are not responsible for the debts of the corporation unless they separately and specifically guarantee them. So the sharing of risk and return of the company is generally in proportion to the share ownership. What we didn't talk about as much in detail yet, so I'll just mention it now, the external financing. We're going to talk about a lot of this later on, but in the form of equity is done, of course, by selling shares to investors or reinvesting profits. With debt, it is done through loans, bond issuances, and leases. Okay, so both debt and equity financing can be accomplished based on a private contractual agreement between the issuer and investor, or more commonly through a traded security. And then finally, we have taxation, which I went through in quite a bit of detail in the last example. Again, depending on the jurisdiction, there may be 1 or 2 levels of taxation, and you can refer back to the earlier example that we did on double taxation to get a numerical example. Looking at the benefits of public listing, they are quite clear on this slide. So for example, having an exchange listing allows ownership to be much more easily transferred because the investors transact directly with one another in the secondary market or on the exchange. So I had alluded to this transfer earlier on. An investor can become a shareholder in a public company by executing a buy order in a brokerage account, or it can also, this person could reduce ownership position by executing a sell order. Now, it will generally be immediate if it's for a small number of shares in a liquid stock, or it will take a bit more time for a large number of shares in a relatively illiquid stock. Okay, so the rest of the points on this slide in benefits of public listing are pretty straightforward. So we're going to move over now to private listing. So because private company shares are not listed, of course, they do not trade on an exchange, and therefore there is no visible company valuation nor share price transparency. So some of the benefits of public listing here are lost. So ownership transfer, of course, is much more difficult than public company shares because of this lack of marketability. Okay, so that would be one salient point that I would want to make here. So lack of marketability. Okay. Moving forward here, a private company shareholder wanting to sell the shares, of course, must find a willing buyer, and the two parties, of course, must negotiate a price to exchange at. So essentially here, your investment is more illiquid. It's locked up until the company is acquired by another company or it goes public. Okay, so in summary, I would say when looking at the benefits of private listing, consider that many early stage companies are private. So if they are successful, the equity investor could earn higher returns. Okay, so that's sort of elaborating on the second point. And then to also elaborate a bit more on the third point, there are fewer disclosure requirements. And so that, of course, is going to lower the normally high compliance costs. Plus, there are relatively few regulations and costs associated with raising financing in private transactions, at least compared to public listing, which there's a lot more regulations that you need to follow. All right, there are generally three ways to go public, okay? And they're listed very clearly on the slides. I'm going to just sort of focus on those three, but the last item on this slide here is a subset within acquisition is one way to really think about it. So I don't really think of it as a fourth item. So let's start number one here with IPO, right? So with IPO, we could just sort of tie this to the Tesla example. So to complete the IPO, this was back in 2010, Tesla would have had to meet specific exchange listing requirements and would have had to hire an investment bank acting as a financial intermediary to underwrite the sale of the new shares. The proceeds of the sale of the new shares would then go to Tesla, and then its shares would then begin trading on the exchange. Okay, so those are the mechanics, the basic general mechanics of an IPO. Let's talk about direct listing. With the direct listing, the example we have is a little bit more recent, 8 years later, in the case of Spotify. So direct listings are far less frequently used in practice. So let's at the same time here do a comparison to the IPO here by Tesla. So as a comparison, Spotify would not have had to hire or engage an investment banker because it didn't have to issue any new shares, right? It's only the existing shares, no new capital. So Spotify would have simply listed its existing shares on an exchange at a price that is determined by the market. Now, shares become available to the public as they're sold by existing shareholders. So direct listing here is in theory a quicker and less costly process compared to IPOs. But, and I say but, direct listings, of course, can generally only be successfully executed by larger and more established companies with a recognized brand such as Spotify. Okay, so this, I mean, although this sounds great here, you do need the brand name recognition in order to do this seemingly simpler and less costly transaction. Now, the third one, acquisition by public corporation, that's pretty straightforward to understand. And we see this in practice all the time. The acquiring company is usually larger so that an investor in the combined entity has reduced exposure to the private company that was acquired. So I'll elaborate a little bit on this last point, the SPAC, or the special purpose acquisition company. This is publicly listed and often specializes in a particular industry. There is a finite time period, let's say, 18 months as a common example, to acquire a private company before the proceeds are returned to the investor. Although SPAC investors may not know which private company the SPAC will ultimately purchase, they may have certain expectations based on the SPAC executives involved. Now, once the SPAC completes the purchase of the private company, then that company becomes public. All right, let's continue and go the opposite way, right? We could here go public to private, and that does happen in practice. The investors, of course, usually have to pay a premium above the current share price and often use debt to finance the acquisition. So hence this example of a leveraged buyout, that's using debt. So going private transactions are initiated by investors who think that actions could be taken that would result in a higher company valuation than reflected in the current share price. Okay, so in other words, if you ask yourself why this might be done, because they believe it's undervalued. Okay, so they can sort of take it private and fix up a few things here. Going private is also great because it does take the company out of public view, which may be beneficial, just for keeping, things more secret and under the radar, so to speak. Now, let's take a look and see what some of these actions might be, some of this restructuring, right? So, and having more control over the company as well. So this could be demonstrated in by example, management changes, sort of getting rid of ineffective management and hiring more effective management, selling redundant assets, and just in general restructuring operations to make them leaner and more efficient, for example. So, of course, the thing here is that we say public to private, and it could also go back to public again, right? So possible that once these actions are complete, the investors may take this company public again in a few years if they're able to achieve the desired higher valuation at that time. Okay, so you could think of this in some cases as sort of a rehabilitative exercise to maximize the value. All right, let's go and take a look at this example. It's a brief example to illustrate the differences between private and public corporations, which is exactly what we were just talking about. Now, it's quite straightforward in that looking at the case facts here, the fact pattern, there's a lot of involvement in the company by one owner. There is no reliance on equity financing, right? And debt financing is simply through a bank. So if I was putting that all together, I would conclude here that this issuer is private based on these three reasons, which perhaps each on their own might not be thoroughly convincing, but the three of them combined together here make it quite convincing that the issuer here is private. Okay, let's do another question here after this. Okay. All right, this is critical reading. Corporate issues are characterized by all of the following except, okay? So make sure you don't just pick one of the answers that is correct here or in the affirmative. They asked for except, okay? So we're looking at the corporate form of business. Choice A is a correct statement since there are two levels of taxation as we discussed earlier. Now, answer B, choice B is also correct since there is separation between the owners, who are shareholders, and management. Okay, so through process of elimination here, that is going to leave C. Right, now this is incorrect because actually there is separation between the owners and the corporation. So another way of saying this, of course, as we said earlier, the shareholders' personal assets are not at stake and cannot be used to cover the corporation's debts. So that makes C the correct answer.